Welcome everyone to the latest ASA webinar amidst all of the crisis management that we've seen recently to deal with the fallout from coronavirus. The Central Bank of Nigeria, the CBN, has set itself another policy challenge, which is to unify the multiple exchange rates for the Naira. It's a change that, if successful, could mark a turning point in encouraging intra-Africa trade and foreign investment. But first of all, there are significant challenges to overcome and questions that will need to be resolved. Fortunately, today we have a uniquely qualified panel to work out, to address some of those questions and to assess really what's likely to happen next. Where will the Naira go? What will happen to the various different rates? I'm Gavin Sirkin, standing in from my previously advertised colleague Bosun for today's webinar. I'm the managing editor at New Markets Media and Intelligence, and we work with researchers, media, governments, businesses to increase understanding of business activity going on in frontier and emerging markets, with particular focus on Africa. Our hosts for today's webinar and the webinar series that we've been running is ASA. And ASA, for anyone that isn't aware, is Africa's leading non-bank currency broker, transacting over $1 billion a year. And it stands really dedicated to keeping free trade in Africa firmly on the agenda through this webinar, through other forums. Please meet our esteemed panelists. We have His Highness Mohammed Sanusi, the 14th Emir of Kano, who was the governor of the Central Bank of Nigeria, of course, from 2009 to 2014. We have Popoola, who is Nigeria Chief Executive Officer for Renaissance Capital. We have Nkemdilim Nwadialor, who is equity analyst at Tellimer, who focuses on Nigeria and West Africa banking. And we have Oghenefejiro Eduviere, who is FX trading associate at ASA. So welcome panelists, welcome everyone. While we look to answer all of the questions sent to us in advance from a very significant group of participants on today's call, please do post any other questions, share your thoughts, anecdotes, your opinions. You know, we'd welcome this to be a very interactive exchange. Use the Q&A function or the chat function, and I'll keep a monitor of those and do my best to address whatever you have to share. If you can, share your name and your organization. We'd like to keep that interaction, but if you'd rather not, that's also fine. Be aware we do have journalists on the call, so everything is recorded and for broadcast. Journalists, if one of the panelists does say that this is off the record, please do respect that, because we also want this to be an open engagement for the professional businesses that are on listening in as well. So first of all, I really want to understand from the panel what you understand by this word unification. What is the central bank's policy? You know, are we going to see unification as in the same rate running through, or are we going to still see various different rates? I'd like to put this first of all to Mohammed Sanusi, if I may call you Lamido. What is your view on what the CBN's policy actually is right now?
Thanks, Gavin, and thank you for inviting me to this webinar. The central bank has always been guided in the definition of unification by the IMF position, which is that multiple currency environment is one where the difference between the rates exceeds 5%. And it's always tried to keep the gap between the official rate and the interbank rate and even BDC rates to within that range, usually about 3%. What you have today, obviously, and what you've had in a number of periods since 2015, has been that this rule has been observed in the breach, with huge gaps between the official rate and the NAFEX and also the BDC rates. I think what the central bank is trying to do is bridge that gap, and I think and the moves that have been made in January and in July have brought the CBN rate and the NAFEX rates closer. the BDC rate remains an outlier. And I think we shouldn't get, unfortunately, it's such a small percentage of the market, but it does have an impact on speculation, which is why it's important to fund that market. So when you see this huge gap between NAFEX and BDC, it's just a reflection of funding being taken out of the market because of shortage of foreign exchange. And once the central bank has enough money and funds that market, it will probably converge to also, I would not be interested in moving the rate towards 470, for example, but would like to see a convergence of CBN and NAFEX, which will take care of over 90% of the transactions in the market, and there's some small funding for the BDC rate to bring it back to that level. I think that is the general direction the central bank is going in. It's what everyone has been proposing for the last 3-4 years. It's what the IMF and the World Bank have asked for. It makes for policy transparency. It makes for clarity of direction. It also reduces the speculative demand for Naira as people just continue to anticipate a continuous cycle of devaluation. So for me, this is central bank finally basically saying we will do what the market has been asking for.
Okay, Lamida, thank you. Temi and Nkemdilim, from the market side, how do you see what's going on with unification? Do you see it as reducing speculative demand? Do you see this range of 3% actually happening? Temi, perhaps if you'd like to start us off with that from the market side. Temi, you're on mute, actually. If you can unmute, there we go.
Schoolboy error. Thanks everybody. I'm glad to be here. I think there is a sort of maybe clarification I think we need to do, which is two, in my view, central themes. One is unification, which the Emir has just very kindly sort of talked about. The other is liquidity. So if you go back a year or two before now, right, both topics have remained not necessarily mutually exclusive, but they're both independent topics. So we've had an FX regime where there was multiple rates, so no unification, but there was liquidity of FX. I think that in this, call it new regime, and in all of this talk around unification today, both topics should not be marred or should not be mixed together. So I fear that now we may be going to a regime where we have the reverse, where there is a unification around a particular rate, but there is no liquidity. And frankly, we can talk about which is best or what if either of them actually is sort of optimal. So that's the first point, right? I think unification, we all understand what it means, but there is something around unification and there is something around liquidity. So that's the first thing. And the other thing was to just, make a quick comment around multiple rates. The reality is that multiple rates do have their place in monetary sort of policy management. They typically are handy and useful when you have massive shocks, balance of payment shocks, crisis, just like you saw in 2015. So what they do is actually just help you smoothen out volatility, help the broader economy. And it's almost a way of just dispersing what should be short-term pain down the line. Of course, the question then is, what is the right amount of time for this? And is that really what defines your broader FX policy? All of this around unification, the IMF, the World Bank have been sort of arguing against multiple rates since the 1940s. So this is a topic that's been there. I think the final thing I'll say is this, is that if you look globally today, there are very few economies, if any, that are developed, that are functioning properly, where you have multiple FX rates. So, everything around corruption to just, lack of transparency. And in my view, just the biggest deterrent here is just the distraction that this thing tends to cause, right? As we speak to people.
And Kim, do you see this move towards unification, but the liquidity problems that Temi foresees, do you share that view? How do you see the CBN's policy?
Okay, so let me address the first part, which is why I agree with Temi, and undeniably, yes, in the space right now in Nigeria, there appears to be a sort of liquidity gap in the FX markets, and that has undeniably contributed to how far the parallel markets are trading. Because if there is such low liquidity, demand and supply, the price go high. I believe that unification is long overdue. It's much needed. It's a no-brainer at this point. But what I would like to point out, though, is that the CBN has not yet released any sort of framework or any sort of overview around how it plans to unify and what the post-unification rate potentially could be. We had the Citibank call where it was sort of touted and mentioned, and then we also had the move I think 2 weeks ago where the NAFEX rate was taken higher to I think 386, but we still do not have concrete phasing or understanding of what is happening to bring about the unification. We don't effectively even know what rate will be determined as the rate to rule all rates, post unification. So I think that understanding that there is a lot of talk but very little action is something that should be in the mind of everybody looking at the Nigerian markets right now. There is a lot of talk and there is a lot of possibility that the unification will come through. However, in terms of actionable steps, plans or policy layouts, we haven't necessarily seen that from the CBN, and so we can't speak very confidently on where we think post-unification rates should be. That all being said, it is long overdue and unification needs to come already.
Okay, Fejiro, I want to come to you in a second, but if I can ask Lamido, from your perspective, why isn't the central bank giving more clarity? Why is there a policy where they're not being clear about either the rates level? I can anticipate why they would not want to be very clear, because they don't want to encourage speculation against what they're trying to do. But what's the game plan, do you think?
When I was in the central bank, and I think that just continues, central bank had a policy of basically giving guidance on a range within which the rates would move. And we had a soft peg. And frankly, the level is always determined by the levels of demand and supply. And I do have a lot of sympathy for the central bank at this moment. A lot of the shocks you're having are shocks that the central bank has no control over. Nobody knows what's going to happen to oil price. Nobody knows how much the central bank is going to have in its kitty. It would be a very brave governor of the central bank who would announce a target rate when he doesn't know how much is going to come in and what's going to happen to the oil price tomorrow or the day after. And the entire world is going through shocks. I think it's extremely important that we recognize that the only clarity that central bank can give at the moment is to say we do plan to converge, and that means the official rate is going to be devalued, but we're not going to do it in a rapid and disorderly manner. Now, going back to the question on liquidity, it's a function also of the price. So you've got a lot of portfolio investors who would like to take their money out today. You've got about, I think, 4 billion on the wait list. The reserves of the country are 36 billion. The central bank has about $28 billion of reserves. So it's clearly not a question of the central bank not having enough money to pay this. But would you just pay off 4 billion at a go? And at what price? If people want to take their money out at any price, they could take a huge devaluation and take a hit. But if they want to preserve the value of their currency, there's some virtue in waiting for an orderly unwinding of these backlogs. Because we must remember that when COVID hit and after the Russia-Saudi fiasco, oil price went down to $10 a barrel. I mean, Nigerian oil, the cost of production is about $22 a barrel. So basically, reserves disappeared. And there will have to be, something will have to give. So you can either take a huge hit today, buy dollars of 500, 600 Naira and take a loss, or wait a few weeks, wait for oil prices to stabilize and have the central bank give you your money at a relatively good rate. So I think what the governor is trying to do is accept the reality that the value of the Naira today may probably be higher. Naira may be overvalued today somewhat. And we need to go through some really effective exchange rate devaluation. but also do that in a gradual manner so as to minimize the shocks to the economy. The second thing I'd like to say, and maybe I'll have time to talk about this later, is that the central bank is taking too much of a burden for inefficiencies in other areas of government. Okay, so if you go back to 2019, I mean, one of the big issues I had with NMPC were basically that a lot of the way things were being done basically deprived the central bank of the dollars that it needs to maintain stability. Now, the NMPC has just published its accounts for 2018, I think, and look at the kinds of things that are happening. NAPIMS, for example, take the general administrative costs of NAPIMS after taking out subsidy payments, 1.3 trillion naira on revenues of 5 trillion. I mean, that is basically over a quarter of the federal government's retained revenue. Okay, these are published figures on NMPC guidelines. Take NDPC, which is the production arm of NMPC. It has 578 people on the payroll. 554 of them are senior management, but administrative costs are $525 million. We're spending $900,000 per head on administrative costs in MPDC. Now, all of that money properly managed, and then when you add the subsidy that has been removed now in 2018, the subsidy, according to NAPIMS, was over 890 billion. That's about $12 per Nigerian. You know, so the fact that we've now gone out of subsidies, we're increasing VAT, you know, you've got to look at this exchange rate policy with the context of a number of reforms that are happening, which should make things better if pursued to the logical conclusion. But beyond removing subsidies, beyond increasing VAT, we also need to look at the cost structure of the major foreign exchange guzzler, which is NMPC, and make sure that we reduce those costs and we get more money coming to the central bank. That will make the job of the governor easier. But I do feel, I am sympathetic to him. He's basically juggling too many balls, and everybody expects him to be the Minister of Power, the Minister of Agriculture, the Minister of Industry, and everybody. I mean, one of the questions is, how will this convergence affect production? I mean, this is the Central Bank of Nigeria. He's not the Minister of Trade and Industry, for God's sake. But everybody expects the central bank to fix all the economic problems of the country, and this is a problem.
We'll come back to a lot of that. There's some very interesting points there, and the numbers that you cite there are quite incredible. I do want to focus more on those areas, but first, Fejiro, just you know, we as Lamido said, you know, it's hard to you can't expect full disclosure, full clarity from the central bank on the direction on the rates, but you know, if we can learn from what's happened so far, just draw a sketch for us of what we've seen so far, and perhaps what the reaction is from some of AZA's clients out there. You know, how is this being perceived by the market?
Well, from what His Excellency said, and what my other panelists have mentioned, that there has been no clear framework by the CBN of when this devaluation, or sorry, when this unification is going to happen, or how it's going to happen. But currently, what we see in the market, we see a lot of destruction in the market where clients are becoming more risk adverse. We see demand actually driving the black market. As of yesterday, there was a divergence between the official market and the black market by 85 naira. This was as a result of heavy demand on the black market. So I would like to focus more on the after effects of the unification, as a lot of people are currently asking questions. What happened after the rate unification? Will I be getting the effects at a stable rate, or will I be able to access the effects every given time I need? So I'm trying to make people understand that the effects will not be at a fixed rate, as this is a convergence towards the NIFEX rate. And for the post effect of this unification, we're currently going to see a lot of further devaluation in the Naira, and we're currently going to see inflation. As we all know, currently Nigeria is an oil-dependent economy. We depend a lot on importation. So the importers of goods will invariably transfer the cost of importation to the end users. Now, when that happens, we currently see market price going high, And so this will actually cause a lot of price distortion in the market.
Thank you, Fejiro. You know, from what Fejiro has just outlined, Temi, and what Lamido Sanusi has taken us through in terms of the challenges that the central bank has, and knowing those challenges very deeply from his experience, is the CBN heading in the right direction, Temi, with this policy?
I feel like you're trying to set me up. There's
not at all
negative to that, but frankly speaking, actually, I think the answer is yes. You know, we actually, one of my economists put out a note the other day and precisely answered this question. We do think they're headed in the right direction. I think to the points and comments that everyone has made, the willingness at least appears to be there. They've obviously moved quite a few of the multiple rates that we had. It looks like things are converging to the 360, 380 area. That's a material shift, right? And it's a material shift in the right direction. I think that the point is that we probably need to move a little bit more, all right? The reality as well is that there are several variables, right? You know, we sit here in a sort of, call it more economic type framework, as it were. But I'm sure that, and the Emir can probably speak to this a lot more than I can, but, you know, once the economists leave the room, then everybody else also has a voice. You know, there are political implications to these sorts of things. There are cultural type, you know, barriers to overcome. There's all these, you know, sometimes even security issues to think about, right, when you think about the rate. So I'm conscious of this, all right? But I think that in summary, I'd say that the central bank can do a little bit more, perhaps a lot more. There are several metrics you can use to see that, you know, this policy of, call it multiple rates, and in my view, a need for a shift towards more of a market sort of determined mechanism. Again, no one's talking about a full sort of freely floating FX rate. It's frankly not practical. But the question is, you know, where you are in this spectrum of fixed exchange rates to sort of the other end of completely market-driven type mechanism. One could argue that, you know, post-COVID, we've probably shifted more towards the fixed rate type regime. We argue more for things like a crawling peg. You can walk through things like inflation and interest rate differentials to figure out what, you know, sort of an acceptable move is. And back to the one sort of, I would say, variable that we keep an eye on is FDI. I think that 2018, we had this, I would say, infamous headline where, you know, Ghana next door with what is, in my view, a much more challenged fiscal situation, okay? So you look at Ghana, you look at whether it's debt to GDP or whether you look at, you know, deficits on the budget, on the current account. I mean, they're doing not as great as, say, Nigeria is. But at the same time, Ghana was able to attract FDI on a per capita basis was 10 times what Nigeria was able to attract. So in absolute terms, there's a lot more, but I mean, on a per capita basis, 10 times. I think that is material. And you look at our country, there are three things that you need to solve for. One is, you know, sort of investments into the economy. You need to solve for education, you need to solve for power, solve for electricity. So this, in our view and in my view, is a big part of the equation, as it were.
Okay. And Nkem, I want to ask you this same question, you know, whether the CBN is heading in the right direction, just so that Temi doesn't feel like I'm setting him up alone, if nothing else. And Nkem, particularly also from your focus on the banks and the financial sector, is this the right policy for the financial sector and the banks and the broader economy?
So just to answer shortly, yes, I think this is a great policy that CBN is undertaking. However, this should just be, you know, off the books. You tend to notice that with Nigeria, there is a bit of a socialist personality to the government, you know, in the way it's concerned about bottom of the pyramid, the poor people, and the effects of things on them. And even something like this staggered exchange regime, as was mentioned earlier, also has its benefits and also has the sort of when I say socialist and sort of what's the word I'm looking for? You know, very concerned with the needs of the poor and very, you know, taking into account that having the full devaluation, the effects the full devaluation could have on the economy. That being said, though, I think that one of the first things we should think about with the unification, as Temi mentioned, is the FDI and the sort of confidence it will give to investors, knowing that the uncertainty around exchange rate translations is off the books. You are quite aware of, where Naira will be trading when you invest and when you eventually plan to make an exit. I think the second thing that needs to be mentioned is a lot of the, would I say, operational costs that are around these multiple exchange rate regimes. You have to think about what it costs the government to be providing Naira at 360 in some markets and 380 in some other markets. And as you know, Lamido pointed out earlier, it is being drawn from the reserve. So you have to think about it in that way, and what are the costs that this could save CBN or Nigeria by having one fixed unification rate. Also, I think you should think about the sort of currency round tripping that happens when people have access to these cheaper rates and then can go into the markets with the more expensive rates and cause this arbitrage and and enjoy this arbitrage trading off of that. So I think undeniably the unification is a good policy. Now, looking specifically at the banks, I think that unification, yes, will be great, but beyond that, the banks would need an extra step of a relaxing on capital controls. Because very recently, I think almost all the banks sent out, like updates on monthly USD limits, and virtually every bank has almost halved what their USD limit is. Just for reference, I don't think any of my banks provide a monthly USD limit that can pay the CFA level 1 fees, just for reference. It's that narrow. So when you think about these things beyond even just the rate, and I like that this was pointed out by Temi earlier, beyond the rate, what is achievable in the market? How much flow of capital exists in the market? And I think specifically for the banks, that's the more important part. Liquidity and capital constraints, or the relaxing of capital flows. There is also, just again off the books, for the sake of this, the incessant CRR debits that have happened over the past few weeks. A few of the banks sort of highlight that these debits happen very close to FX auctions. So it's almost as if the CBN is trying to cripple their ability, to come and make heavy ticket demands in the market. Again, this is just speculation, and this is just speaking to the banks and, people in management. But then when you put this story together on the whole, no matter where the rate is trading, if there is no liquidity and relaxation on how capital can flow in and out of Nigeria, the rates, a unified rate can only do so much. It's like a tangent of policies that need to move together. And then just to feedback to what Lamido pointed out earlier, we don't expect the CBN to, be the messiah of everything. But however, you are the highest authority on fiscal and monetary policy. So we do expect the understanding of policies moving together. You don't introduce an LDR rate of 65% and then keep debiting the bank's liquidity. Where are they supposed to provide these wonderful real sector loans? Don't get me wrong, I love the LDR. I think it's long overdue. Access to capital in sub-Saharan Africa it's almost a shame, when you compare us to other markets. I think it's a great policy, but the other policies that have come out don't necessarily seem to be supporting this first policy. So, just to keep it short and sweet, yes, it's a great move, but beyond that, what other policies are there to ensure that the market is functioning as smoothly as possible? We don't expect, as Temi said, a complete free-floating. The ideal is somewhere in the middle. So where is that middle, and what are the policies or add-on policies that will bring Nigeria to that sweet spot?
Jiro, please go ahead.
Yeah. Now, I'm sorry, I have to jump in here. And look, I'm not speaking for the central bank, since I'm not in there. I don't know exactly. I don't have all the information there. But I think we need to look at a number of things. First of all, we have been with this webinar in the middle of an economic crisis. And you have competing demands, all of them urgent. Okay, you've got portfolio investors who want to take their money out. You've got people who want to buy Forex before you have a devaluation, manufacturers, you've got people trying to avoid inflation and so on. And we need to have a certain perspective to this. The central bank has to think with a clear head. Okay, so oil price is not going to remain at $10 or $20 or $30. The central bank has to think, maybe look over the long term, what will the oil price be? It's probably going to come back up anyway with all the arrangements that OPEC is making for the OPEC quota cut, with the when the economy is open. Right now, look, airlines are not flying. The airlines are not going to remain on ground forever. So the central bank has to avoid going into a panic, okay, and basically wait and hope that oil price will go up. The other measures being put in place, the removal of subsidy and so on, these would now feed into higher reserves, and that would enable the central bank basically to have an ordered devaluation. I think it's extremely important to remember that the central bank is not looking at today, it's also looking at the long and medium term. The second thing is, I think Temi has made the point, Nkem has made the point. The argument for unification is there. The central bank's cash flows, for example, if you look at cash outflows in 2019, in wholesale and retail market was about $61 billion. Now, if that was at 360, 335, 360, even if you had a difference of only 20 Naira between that official rate, that is 1.2 trillion Naira in arbitrage. I mean, the argument is clear. I mean, if you have 1.2 trillion in arbitrage, people will take advantage of that arbitrage opportunity. You're going to have people who are going to take advantage of the official market to turn around and sell dollars at a higher rate, okay? And that basically hurts the economy because that is money that should go into importation of raw materials and real production, basically going into speculation because you make so much money by simply buying dollars and selling dollars. The central bank recognizes that, and unification basically closes off some of these arbitrage opportunities. From a fiscal perspective, by devaluing the currency, you get more Naira, and you get more Naira into the books of the federal government and the state government's revenue allocation. And that reduces the debt overhang of the states and the fiscal burden, which we're facing now with so much of the revenues being spent basically on debt service. So the arguments for unification are there. I don't think there's any question about that. But you also have to look at things that, I mean, when we have our views about demand management, but I don't know how many people realize that in 2019, we were spending about $3 billion per quarter just on travel-related expenses. Personal travel, health, and education. That's about $12 billion. You've got reserves of $36 billion, and you're spending 1/3 of that on travel. If you look at import of services alone in 2019, the broader services imports, it was $10 billion. You know, you can't. I'm talking about $10 billion per quarter. $10 billion per quarter on imports of services. So you do have to ask questions about how the structure of the economy, what we spend on education overseas, what you spend on medical, what do they call it? Medical tourism, going to Dubai, going to Egypt for medical services, just traveling abroad. How much we're spending, and how much really of our reserves do we need to continue running down for people who go for things that actually should be best produced locally? And how can we help that by investing in quality education, investing in quality healthcare, investing in our tourism to stop people from having to travel to Dubai, travel to other parts of the country. Now, the central bank needs help from other parts of the country. So if we keep talking about foreign exchange policy in a vacuum, in the next 2 years, we'll be here with the next shock. Because
I think that raises some very interesting points, I think, for Giro, because I know that as a, large part of what ASA does in terms of intra-Africa FX trading really ultimately drives towards encouraging neighbor African countries from trading with each other and not having to go via the dollar, not having to bring in exports and imports from outside of the region. Perhaps talk from your perspective on how you see the upside of unification, where the CBN is potentially driving us to.
Well, on the upside of the rate unification, this is definitely going to help market stability. Definitely it's going to eliminate arbitrage. It's going to eliminate cheap funds in the market. Well, but like I would say there's the major question of cost of production, like His Excellency just mentioned. Now, you are producing at a high rate and importation is cheaper. So you see a lot of business owners are comfortable importing their goods. And as long as they are importing, there will be a huge demand on the black market because some years ago, the CBN came out with 41 items, which are legitimately approved to get FX from the official windows. Now you have a ban on these items and you're trying not to encourage importation. What do? Now, these business owners would definitely source for their FX outside in the black market. Now, you're trying to go for a rate unification, but on the other hand, we'll continue to see a divergence because the black market is solely driven by demand and speculation. Now, you wanting to import more goods, you keep having people pressurizing the black market. So as long as there's no clear framework on importation or the government does not issue more tariff on imported goods that can be produced locally in the country to narrow the gap between the cost of production and the cost of importation, I continue to see a divergence on the black market and the official window.
Okay, please, Lamido.
Well, you know, and I'm sorry I keep jumping in. There are a number of things that I think.
Don't apologize. This is what it's all about.
I think we need to look at. First of all, this convergence and this depreciation of the currency is actually good for the tradable sector, because you need to diversify your export base away from crude oil. We've seen countries exporting cocoa, exporting palm oil, exporting tin, exporting gold, do extremely well in this COVID period, while the oil producers have been battered. Okay, now what this devaluation does is it makes it possible to make more money basically exporting these other agricultural products, and you begin to have a diversification for export, which Nigeria needs. The second thing is that by making the imported goods, as Fejiro talked about, more expensive, it also creates an opportunity for import substitution. And the truth is, a lot of those things that the central bank doesn't want imported, and I mean, I have my views. I don't necessarily agree that banning them from Forex is the way. I think it's the Ministry of Trade and Investment that needs to have policies around encouraging production of those goods. But these are goods that can be produced in Nigeria. Why do we need to import leather products? Why do we need to import shoes and bags when we've got leather? Why do we need to import, why do we need to import petroleum products? Why can't we invest in our refineries? Why can't we push through the turnaround maintenance of our 4 refineries and make sure that Aliko Dangote continues to fast track his petrochemicals industry? Why do we need to import food? Why is Nigeria importing rice? Why are we importing maize? Why are we importing corn? We do not need to spend billions and billions of dollars on these things. Now, I've heard the word socialist. I'm not sure it's so much socialism. The reality is we need to move away from being an import-dependent rentier state to a developmental state. And the only way that can happen is to start encouraging domestic production and have a structural transformation of the economy. Now, it takes much more than a devaluation of the foreign exchange. You need industrial policy. You need a set of incentives and tariffs and subsidies for the real economy. You need to take away all the opportunities for rent seeking and subsidies, petroleum, power, and so you need to fix power. But I think the central bank is doing what it can under these circumstances. I just don't want us to have too much of a hope over the overall economic outcomes of what the CBN is doing without movement on the side of government, on the side of the other arms of government who are critical for economic development. The central bank can only do so much, and there's a limit.
I want to go ahead, Timmy. Please
jump in there very quickly and seize on a few comments that were made. I think the first thing is to realize that, around this topic of, is this the right time to be having this conversation? Of course, there's a crisis going on. And of course, with, call it maybe any bleeding patient and a crisis, you want to just stabilize first, right? It's not necessarily the time for call it hasty type decisions. But the reality is that if you take a step back and look at COVID, I like to look at it like an accelerator. So COVID has been a very sort of massive accelerator of several topics, right? Again, if you step back, whether it's racial inequality, whether it's structural type, differences, it's just been this opportunity to speed conversations up. And that's where I situate this conversation we're having today. I mean, in reality, we've been talking about convergence of FX rates since 2015, even more so in the last year. I mean, April last year, we put out a very big piece. We argued at the time that we thought it was time for unification. We argued that, just everything was in place. Because if we go back to IMF type policy, they argue that as long as it's not sort of 10, 15% wide, sort of the official versus these other rates, it's a good time. If your fiscal situation is also sort of okay, comfortable, these are good times to unify. So we thought the time was ripe last year. So the reality is that this topic has been on for quite a while. And perhaps the COVID type situation gives us an opportunity to speed that up. So that's number one. I think that number two is that, in my view, the reason why there's all of this emphasis on the central bank, and I do agree with His Royal Highness that it might be sometimes unfair on the central bank. I think that there are two reasons for this. One is that the central bank itself has actually taken on a lot more responsibility, whether by design or whether by structural type reasons. The central bank has itself taken on a lot more responsibility than just monetary policy. So if this is the case, sometimes, you might hang certain things around the neck of the central bank, sometimes unfairly so, right? That's number one. But I think that number two, the reality is a lot of the talk about, self-dependency, self-sufficiency, whether in agri, whether in the industrial sector, the reality is a lot of these things also are FX dependent. If you look at agriculture, right? We talk about agri, we talk about, say, rice as a very classic example. The reality is that if you want to modernize that sector, if you want to sort of call it industrialize that sector, I think the last analysis that we did was that for every, say, 10 Naira you have to spend, at least half of that is FX driven, right? You just have to spend dollars to modernize the economy. And so I think, rightly or wrongly, that the central bank is a big part of this nucleus of unwinding and unlocking this sort of Nigerian economy that we talk about.
I want to get into the broader aspects in just a minute, but Fejiro and Nkem, if I can just come back to you, the million Naira question is, what happens next? Where do the various rates go? And I want the audience to actually come out with some numbers, some projections here of what the experts think. Where are we headed? Fejiro?
Looking at the global economic slowdown post-COVID-19 pandemic, you're currently looking at the crude oil levels at $40 per barrel levels. You're currently looking at inflation rate at 13.3%. You're looking at our fixed income rates are currently at 3 point something. True yield is currently at 3.5. When you look at compare with the inflation rate, you are already at negative territory, negative return. So looking at all this compared with the 12-month forward quoted by Bloomberg yesterday at 453 levels. Looking at all these, you could definitely see a kind of future projection that, yes, definitely the Naira might depreciate as low as chances are that it will depreciate as low as 500 per dollar or 480 per dollar within those levels. So looking at everything happen until we see a knee-jerk reaction in the oil price going above the 60 levels, which is there before, I think we might continue to see depreciation towards the 480, 500 levels. Okay,
and Cam Fejiro is saying, we could see the depreciation 480, 500. Where do you come in?
I don't necessarily have a figure, but I don't think it will go that low. I think that we at Tellimer think that non-deliverable forwards are always a good place to look at, just to understand even where investors think your currency should be trading, effectively. I think somewhere within the 450, 460, 470 bracket is quite fair, because just to reiterate what was mentioned earlier, the parallel markets are driven by a lot of speculative forces, and also sometimes the demand dynamics tend to push those rates really high, and that's not entirely reflective of where Naira should be trading. I just would reiterate that I think we at Tellimer think that the non-deliverable forwards are a good benchmark, because these are what investors think that the money should be worth. And considering how much of the volumes in the FX market type are determined by those type of personalities, I think it's a good benchmark to expect the rates to trade at.
And Temi, where are you seeing market rates going from here?
So I'd answer that in two ways. I think that we might be in a bit of a silo trying to answer that, particularly in light of global events. If there is a phase 2 or wave 2 of COVID, for example, we'll probably just have a repeat of what you saw in March, which means that one part of that answer is that this is maybe out of our hands, at least in the short term. Let's put it this way. There's a lot more global type factors at play. And as I mentioned earlier, right, when you think about FX, there's a political side, there's a social side, there's just so many variables that it's very tricky to answer. But having said that, I think the other way to answer your question is just to look more theoretically and ask yourself what are real effective exchange rates. So just go back in history to a time that you thought the rate was fairly priced and just gross that up for inflation and interest rates in that time. Our view is that a 10% sort of more sort of devalued move from here will be fair. We think that at that point you would unlock capital. We think that at that point you would discourage some of the not so real demand that you could actually just substitute locally, for example. So I'd say maybe another 10% from here if you were to force me for an answer. But frankly, what I am looking for at this point is less what is the rate, as opposed to more what are the structural changes that we're putting into place? What are we doing as a result of COVID to answer some of these other broader sort of moving themes?
Lamido, there's a question that you mentioned before, actually, that I want to put to you, which is from one of our participants. The question of whether unification will resolve the absence of production in the domestic economy, and you touched on many different aspects of this earlier. But I want to sort of broaden that question as well to what do you think the CBN should be doing now? What would you be doing in that role right now?
Okay, well, let me take a step back, and I think Chemi will, I'm sure he'll agree with me. Going back to 2015, 2016, I was extremely critical of the multiple exchange rate position of the central bank. I was critical of fiscalization of government deficits. In fact, I suppose 80% of the problems I've had with the government have had to do with my being critical of the policy has been running. So I'm in a strange position today where I am actually defending and endorsing what's happening precisely because this is what we have been saying should happen. Okay, we cannot continue always we don't criticize for the sake of criticism. So the government has said we no longer pay fuel subsidies. That's one thing done. We're going to look at VAT. That's one thing done. We're going to look at electricity tariffs. That's one thing done. We're moving to unified exchange rates. So it's a whole series of things happening that are moving the economy in the right direction. Now, secondly, we also need to look at the numbers. Okay, so if you take the current account balance and trade account balance, yes, they're in deficit, but look at where it was at Q4 2019 and Q1 2020, and you find that the deficit is actually reducing. Okay, so it's important to say we are in a bad place, but as far as Forex is concerned, the central bank probably has a sense that if we can continue in this direction, we will be we'll be moving from both directions. So yes, you're devaluing, but you're also able to increase the funding of the market. Okay, and that reduces the amount by which the Naira will fall to avoid what Fejiro was saying about the very high rates of inflation and the adverse consequences of a massive devaluation of the currency, or even fluctuation as prices go up and down. So look at the current account balance, look at the trade balance, and you find that Q1 2021 is better than Q4 2020. And look at what OPEC is doing. Okay, look at what the other domestic policy, and you think that there's progress. Now, what should the central bank do? I think is like all of us, is to look back over the last 3-4 years and say, where did I go wrong? Okay, there are certainly decisions that would have been taken by both Ministry of Finance and central bank in 2015 and 2016 that would have placed us in a better position today than we are. If you look at, and when you consider what you call the pre-existing conditions, in 2015, when the crisis hit, 2014, the economy was growing about 6%. But when this crisis hit, we were growing at 2%. Okay, we haven't done enough on the power sector. We haven't done enough. We didn't move out of subsidies quickly enough. We didn't reduce government overheads quickly enough. We didn't start introducing transparency in NMPC quickly enough. It's time to just fast track all of those things, take advantage of the learning points of the crisis and lay the foundation for long-term structural adjustment and development. So I think just being honest and saying we may have made some bad calls in the past. Okay, now we're forced to make the right calls. Let us continue in this direction. That's what I would expect the central bank and the Ministry of Finance and everybody to do. And then for all of us to encourage them to continue in that direction and also understand the challenges they're facing.
We've got less than 10 minutes left and quite a number of questions from participants. So I want this to be quite a quick fire exchange, if I may ask for that from the panelists. One from my former colleague at Bloomberg, Emily Onu, he asked, is there a chance that the Naira will actually regain lost value in the future, like strengthening, say, to 360 per dollar at the INE window? And Kem, or Temi or Fejiro, who wants to jump in here?
Okay, first off, I would just like to reiterate what Lamido had said earlier. If we have a much larger revenue base and we have, FX revenue coming from different sources, not only oil, I think there should be even more, and just to fit to the production question on that arm, commodity prices are quite volatile, even though right now gold is a very, secure place to be. There are periods where gold is in crisis. There are periods where livestock is in crisis. Remember the swine flu issue last year. So I think that Nigeria needs to really focus on being an export leader, more or less, or just ramping up its export strength. And I think beyond even commodities trading, we should be looking at value-added goods, finished goods, because those prices tend to, they are less volatile. They tend to fluctuate less. There tends to be less fluctuations in the prices of finished goods as with commodities or the inputs of these goods. So I think if Nigeria can ramp up on its ability to be more export-driven and to have value addition in its exports, because just broadening your commodity export base is not necessarily a safe bet, because tomorrow there could be some weevil attacking cocoa and the prices drop. Next tomorrow there could be some new metal that trumps gold. So it's taking it a step further and going down the line of the production chain.
Fejiro, very briefly on 360 per dollar, the INE window, is there a chance that we could regain lost value?
Well, I will always say in the market, everything is possible. So yes, there's a probability that we might go back to that level. But like Nkem clearly mentioned out, is like we have to diversify our economy to production, more export base. And also we have to look at the last time we saw levels like this. Market, I think that was in 2017, 2016 level. Can you hear me? Yeah, that was in 2017.
You're cutting out a little bit.
So
go ahead.
Looking at the last time this happened, we saw a lot of tools that were deployed by the central bank to regain stability of the FX. But the question right now is, by then, crude oil was around $60 per barrel. You're looking at crude oil at $40 per barrel. You're looking at inflation then was around 10% level. You're looking at inflation now at 13%. You see the global economic slowdown. You're looking at China being one of our biggest buyers of crude oil, having a slowdown in their economy also, and the US dollar index actually going down. So with all these indicators, the question is, can this possibly happen again? Will the CBN be strong enough to defend the Naira towards bringing it back to 360 levels? We are looking at our debt portfolio of already $27 billion. That's 75% of our external reserve. So from a point of view, I likely will say I don't see this happening anytime soon. Yes, there's a probability that it will happen, but I don't think it will happen anytime soon.
Okay.
Gavin,
please.
I mean, look, for me, underlying that question is some presumption that maybe it is desirable for us to move back to that position. And I do think it is. I would certainly discourage the central bank from even trying to just get an appreciation of the currency. Even maintaining the fixed nominal rate in the face of rising inflation has stopped us from having a real effective exchange rate depreciation, which we need in order to be competitive. So the idea that the central bank should be interested in getting back to 360 it's not. I mean, if we've gone beyond that, we've gone beyond that. If we're able to bring down inflation, if we're able to have structural changes, then that's fine. But with the structure of the economy as it is, the obsession with a strong nominal value of the currency hurts the real economy. And this is really what we need to get. I mean, there's always a trade-off. You can protect the portfolio investors and give them the dollars they want at a fixed exchange rate. But what is the cost? What is the cost to reserves? What is the cost to inflation? What is the cost to the amount of currency that's actually going into real production? So these economic trade-offs are there. And I think having a weaker currency in order to trade off for economic growth is something that central bank should go for. I should say that the most successful governor of the central bank on exchange rate management was Governor Soludo. I mean, oil price went up to over $140 a barrel. And Soludo was able to have a real effective exchange rate devaluation. I don't know any central bank governor who has done that. I certainly did not achieve that much as I tried. And I think that that is the mindset we need to keep. We need to keep aiming for what the central bank did at that time, which was why when the 2008 financial crisis hit and I became governor of central bank, we had the buffers against which we could carry out the reforms we did. And if we had that kind of crisis today, the current central bank governor will not have those buffers. And I think it's important not to make the mistake of depleting reserves in order to protect the currency, because you have to think of the next crisis, the next central bank governor, and the long-term future of the economy.
So a very humble perspective. Thank you, Lamido. Temi, last word on this.
Yeah, I'll just say that, you can look at this from just pure demand supply type of, sort of standpoint, right? Look at the currency or the dollars as a commodity, right, for which there's demand for and there's supply of. The reality is that you've seen a massive crush in demand because of COVID. There's no one traveling anymore. There's no school fees to pay, sort of medical tourism, and even just economic growth. So the demand side has been crushed. So that's probably technically a positive. But I think that in reality, the supply side has seen an even bigger crush, right? That's the reality of things. So I think from that standpoint, it's practically impossible to see a Naira strengthening. The other point is that, and I think it was touched on earlier, just inflation and interest rate differential. The fact that you can get dollars at close to 0% internationally and bring that to a market like Nigeria and get high single-digit type returns. Just basic economic arguments tell you that it's very difficult for such a currency to strengthen. So I think if we were to bet, it's certainly one direction, which is not to strengthen.
Okay, we're approaching the hour. We've got lots of very interesting comments that I'm just going to try and summarize very quickly. Joel Ayana says central banks should just come up with a robust policy focused on FX so that people don't continue to speculate. Idris Olufawubi says, in my view, unification of exchange rates will devalue the Naira more, and the aftermath will cause inflation as the disparity between the I&E window and the black market will continue to widen. Felix Oloyede says, if the central bank should unify rates, will corruption in the government not make a mess of this effort? I guess that's to be seen. He points out that in the past there are farm extension workers and inspectors who visit farms to get the first information from farmers directly, which gives better results, but we don't see that anymore. So much is domiciled in NISAL and IRSAL for disbursement to farmers as loans. So as an illustration of the scope for corruption there. Adebayo Obaratumi says, His Excellency talked about the need to move away from import-dependent economies to a manufacturing one, given that the majority of raw materials used for local manufacturing are imported. Don't you think FX convergence will ultimately cause an increase in the cost of locally manufactured goods? And I guess that's one of the downside effects to watch out for. And Courage Iroro says, I totally agree with His Excellency on production, but there are so many factors holding that back right now in Nigeria. So just like Temi suggested, what we need to do is stabilize the wound for now, and then it can be treated later. We have to leave it. I'm sure that that's triggered all kinds of different thoughts from the panel, but I want to thank very sincerely Mohammed Sanusi, 14th Emir of Kano, former central bank governor of Nigeria, for giving us his time today. Temi Popoola, the Nigeria Chief Executive Officer for Renaissance Capital, and Nwadialor, the equity research analyst at Tellimer, focused on Nigeria and Ghana banks, and Nkemdilim Eduviere, the FX trading associate at ASTA. Thank you also to the team at ASA for putting this and our previous webinars together for your analysis and organization. We've left many issues to discuss still, and that will be ongoing on the Twitter feed at ASA Africa. ASA is committed to supplying liquidity into the market and treasury solutions through its BFX product, which you can find more details about at tradebfx.com. So please do interact with us on Twitter, on other platforms. We'll be back with more webinars, so also watch that feed for the next discussion, and we look forward to seeing you next time. Thank you, everyone.
Thank you, Gavin. Thanks, everyone.
Thank you, everybody.